Billions to Trillions to Action, Mobilizing Finance for Development 2016 to 2030. The Potential of Institutional Investors in Development with Afsaneh Beschlos.
The role of the private sector in overall finance has changed hugely. If we look today at the size of the public sector versus the private sector, in the private sector nowadays you have almost in excess of 17 trillion in equity markets, you have in excess of 14 trillion in bond markets. The multilaterals and the World Bank obviously is the largest. The World Bank in terms of IBRD and IDA together in terms of commitments or lending, depending on what numbers we look at a given year, may be more in the 40s at a relatively high level, and that's in the billions versus the trillions. So when we look at those kinds of numbers, the relationship of the private sector versus the public sector becomes much more clear to us as one that has become increasingly important. The growth of the private sector has been phenomenal in the last 15 years. Obviously, we had 2008, where the relative shares of public and private sector changed a little bit. But if you look at the numbers, the private sector took off right away after 2008 by quite a large number. The interesting thing in terms of the last 15 years is really a little bit of the role reversal and the relative importance of the private sector having taken off across many, many areas. And not just in Asia, I would say, and not just in Latin America, but if you look at Africa, the role of the private sector has become incredibly interesting. And you see private sector now investing in Africa, in infrastructure, in private equity, across the board in real estate, also in health and education. The large institutional investors, this includes large pension funds, it includes large sovereign funds, it includes very large university endowments and foundations globally, were really generally initially investors in their home countries. A lot of them have a huge interest in emerging markets. Why are they interested in emerging markets? Because they have a need to have a return which is in the 6% to 10% range. And they're finding that in their home markets, they don't always get those returns. Whereas in emerging markets, given the relative growth is higher and the inefficiencies are larger, there is a lot more potential to have highly profitable and high margin investments. Institutional investors are looking for returns and they're looking for a number of other things when they look at emerging markets. One thing they look at when they look at emerging markets is diversification. So when they look at investing in emerging markets, they're very interested in finding something which is not correlated with their other investments. What does that mean? If they're investing in US equities or they're investing US bonds, they want to invest in an asset class that when US investments are not doing too well or European investments are not doing too well, they will do well in this other asset class. That's what it means not to be highly correlated. So emerging markets sometimes moves along with other equity markets and sometimes it doesn't move along. Obviously, having a transparent economy and an economy where the rule of law is fairly well established is really important. An economy where there are opportunities and that whether you're a foreign investor or you're a local investor, you feel that you are treated relatively on par. Not maybe perfectly, because even in the developed countries, you don't get always treated on par, but closer to each other. Other things that are really, really important, obviously, is return and risk management. Can you understand political risk of investing in this country, the economic and social risks of investing in this country? And those are things that large global investors don't worry about when they invest in the developed world. If you look at countries that have kind of jumped over the hoop to the developed, like Singapore, and then you start going behind them on countries like Korea. And then you go further back, you look into, let's say, Africa and look at Kenya. all in very different places in terms of their economic development, very different places in terms of transparency and in terms of governance of their companies. But what you will see that is in common is the fact that their governments have tried to create a climate that provides more transparency, a climate that provides more rule of law relative to what they had before and within their own regions. We're investing a lot in a number of African countries that really 10 years ago or 15 years ago were total no-nos in terms of corporate governance, in terms of transparency, in terms of corruption. Now we're finding in countries like Tanzania that we can invest across the board, whether it's a salt mine that is creating salt for local consumption, whether it's roads, whether it's power sector, whether it is the gas pipeline. There are just so many interesting opportunities. Infrastructure has a really important attribute, which is that it needs investments that are long-term, and the returns are long-term. There are quite a few ways to help leverage the resources of MDBs with private sector funds to finance infrastructure projects. What has been really classically used is $1, let's say, of an MDB investment in an infrastructure project has often attracted another 6 or 7 from a private equity group or from an infrastructure fund. And that has allowed very large projects to get financed. If you look at Umemi project in Uganda, what was interesting was the role of the bank to both provide some of its tools, but also help create better energy regulation in Uganda that then allowed a private equity firm like Actis to come in and invest in a very highly leveraged way and provided a lot of resources to the electricity sector in Uganda. One other area which is really just starting to happen to finance these large infrastructure needs in emerging markets is creating projects where, for example, just like in the developed markets in Europe or US, you have toll roads where the investors are paid by the users of these roads or other transportation means. We're starting to see some of those develop in emerging markets. I think while the interest has been in infrastructure, let's not forget private education and private health sector. Obviously, what we've seen in emerging markets is, particularly I would say in the last 5 years in Africa, in Latin America, Eastern Europe and Asia, huge increase in consumer sector. That's an area where, because of the poverty in many of these developing countries and frontier countries, you didn't see much growth. And that has been a drastic change, I would say. As you've seen, the patterns of consumption in emerging markets have changed. And whether you're in a large city, but even if you go into agriculture areas, you see people using telecommunications and they have their mobile phones because that's the source of any kind of economic activity in addition to whatever their main job is. And what you see people spending next on is the education of their children and their health. And as we well know in these countries, the countries are starting with a fairly low base for the masses in terms of education and health. And you're starting to see private sector solutions and private-public coming together to come up with solutions to the education and health problems and coming up with projects that have also very good rate of return. What will shock you probably, this last year, emerging markets in 2015 has been down, depending on which region you look at, more than 10%. But actually the health sector returns in emerging markets is up for the year. So that tells you that there is a lot of potential. In India, we just had a seminar recently and there were quite a few players from academics and policymakers all the way to large investors. And what you realized is that with Mr. Modi's reform and his great energy to get investors across the globe interested in India, there are a number of opportunities we are looking at right now. These range from power projects, turning some of the coal-powered plants into natural gas powered plants. They include power plants all across India. They also include looking at providing low-cost housing for people who are living in slums right now, and there are actually quite a few very interesting investments there that provide the same rate of return as other areas and can ensure that the poorest of the poor in India get housing. Going to Africa, you see some incredible opportunities. For example, there are no emergency health services in some African countries. So even in the African countries that are oil producing and relatively better off with a smaller population, if someone gets hit by a car or has an accident, either, unfortunately, you are left to die, or you're sent by air to Kenya or to Europe, which is a hugely expensive venture. No ambulances or emergency care. There are private sector groups that are looking in providing emergency care in some of these African countries. And you can see that there is even ability to pay and is going to reduce the cost of dealing with emergencies and provide interesting rate of returns. What is now very important for the MDBs, and in particular the World Bank, is to take its resources and knowledge to turn some of these goals into real projects. How do you do that? You take climate change or you take poverty and you come up with actual projects that the bank has on its list, and you provide those to the private sector investors who are looking. And you help to fit those into the asset classes that the large institutional investors are investing in. Large institutional investors have equity buckets, they have bond buckets, they have private equity, and for the World Bank, if it could help to come up both with an actual project and see how it fits into the categories and buckets that institutional investors use, it would be so much easier to get these goals achieved.